Hey, in today's video, we're going over how are your accounts taxed as you're preparing for retirement. You've got traditional, you've got Roth, you've got a brokerage account, and maybe you got CDs at the bank. How are the accounts taxed? Because they're all different. And if they're all different, it might be that one is better than another for you. My name is Mel Stubbs. I'm a financial planner with Christy Capital Management. Let's get ready to talk about taxes. So tax planning, it's not only about finding ways to pay less taxes in any one given year, but finding ways to lower your lifetime taxes. And so to lower your lifetime taxes may actually mean you pay more today. So that's a key thing. We may need to move taxation sooner in order to pay less. And so you might want to work with a professional. If you're not working with professionals doing proactive tax planning, then you're potentially paying more in taxes than you need to. Not because your tax return was done incorrectly. Instead, you may potentially be missing out on tax strategies that, if used correctly, can save you tax dollars, thousands of dollars, hundreds of thousands of dollars. And so this isn't sometimes working with a CPA doing your tax return. Their main focus is, how do I pay the least amount of tax this year? We're looking past that. These might be the low tax years. I'm worried about the super high tax years, 75 and over. We need to work on that. So myth versus reality. Who is tax planning for? Well, tax planning is just for the ultra wealthy. I mean, it is for them. It's not just for them. Tax planning can be done with any asset balance. And even if you're 59 and you've got $400,000 or $500,000, it's going to be a problem at some point. It's the size of the problem. The more money you have, the bigger the problem can be. But you'd be surprised with the compounding interest and with lots of feds, with the pension, the supplement, Social Security, a lot of times they're not touching their TSP very much. And so it definitely multiplies and then causes the tax issue. So smart money list. There's 3 different types of an account, but the first one, not of the 3, there's free money, that's the best. Then we got 3 different types of accounts. So free money, this is the 5% match. Inheritance, obviously free money is the best money. So definitely, get your 5% match if you are able. And so to get your 5% match, you have to contribute 5%. So if able, please do that. Now, as far as the different types of accounts, the first type of account, we'll call it taxable money. It's not traditional, it's not Roth, it's just a regular account. For some of you, it will be like a savings account that pays you interest, money market account, a CD. These type of accounts, give you interest. At the end of the year, you're going to get a 1099. You have to pay taxes at your tax bracket on that money. So not capital gains rate, but at your tax bracket, which is worse. So you might have to do that. If you have a brokerage account, let's say, I got a Fidelity account, I got some mutual funds in there. If there's a gain, if you sell something, you had a profit, you have to pay capital gains tax on that profit. And so it's a taxable account. It is a non-qualified account. It does not qualify for like traditional or Roth, those type things. And so, the great news is you can access this money at any time. There's no age limits or any of that stuff. Problem is, if there's profit, you got to pay taxes. If it's a CD or a bank account or something like that, you're paying taxes every year. And so this can kind of eat your lunch if you have too much money here. You need some, but maybe not too much. The next one, tax deferred. This is your traditional TSP, traditional IRA. You are postponing taxes for later. And so just to remind you, this is your paycheck that you got paid and you said, don't pay me. I want you to put in the TSP. Hopefully it's grown over the years. And so when you take money out, it's your paycheck. So you have to pay taxes at whatever the tax rate happens to be then. So that could be a problem. Well, what's the tax rate going to be 20 years from now? We don't know. And so if it's worse, we got problems. If your traditional balance gets really big, we may have some problems. But tax deferred, you're postponing taxes for later. Then we got tax free. This is where you get paid. Instead of, don't pay me, send it to traditional traditional TSP. You say, no, pay me. Let me pay the tax. Now I'll send it to Roth TSP. No taxes anymore. Growth tax free. You take a distribution tax free. You do have to be 59 and a half or over and had a Roth IRA account for 5 years. Assuming you got that, tax-free gains. So now that you know how each account type is taxed, you can better plan for your retirement. If you need help looking through the accounts that you have, if you need help shifting money to the account type that you want, we've helped lots of people move money to Roth because they've deemed that that's the better account for them and their planning. Reach out to us at ChristyCapital.com. If you want to watch another video on tax planning, click right up here. My name is Mel Stubbs. Go to ChristyCapital.com. Talk to you soon.